You work your entire life for this moment. You save, you sacrifice, you say no when others say yes. And now, finally, retirement is either here or right around the corner. But there's one fear that quietly sits in the back of your mind. What if the market crashes and I lose everything? Let me tell you something very clearly, because this is where most people go wrong. A stock market crash is not what destroys retirement savings. Your behavior during that crash is what does. And if you don't understand that, you could take a temporary drop and turn it into a permanent loss. So let's talk about how you protect what you've worked your entire life to build. Because this is not about luck. This is about strategy. First, you need to understand the truth about the stock market. The market goes down. That's not a possibility. That's a guarantee. We have seen crashes in 2000, in 2008, in 2020, and there will be more. So if your retirement plan is built on the hope that this time it won't happen, then you don't have a plan, you have a wish. And hope is not a financial strategy. Now, here's the part that may surprise you. If you are properly positioned, a market crash should not scare you. It should already be accounted for. The real danger is when people are overexposed to risk right before or during retirement. Let me ask you a question. If the market dropped 30% tomorrow, would your lifestyle change? Would you panic? Would you feel forced to sell? If the answer is yes, then you are taking too much risk, period. Because once you are retired, you don't have the luxury of time. When you're 30 or 40, a market crash is inconvenient. When you're retired, it can be devastating because you are no longer earning income to replace what you lose. So the first step in protecting your retirement savings is this. You must reduce your exposure to volatility as you get closer to retirement. Not eliminate it, but control it. That means your portfolio should not look the same at 65 as it did at 35. And yet, I see this mistake over and over again. People stay heavily invested in aggressive stocks because they're chasing growth. But let me tell you something. At this stage of your life, it's not about getting rich. It's about not going broke. There is a big difference. Now, let's talk about something called sequence of returns risk. And this is one of the biggest dangers you've probably never been told about. If the market drops early in your retirement while you're withdrawing money, you are locking in losses. You're not just losing money on paper, you're actually draining your portfolio at its weakest point. And that creates a snowball effect that can shorten the life of your savings. So what do you do about it? You create a buffer. You don't keep all your money in the market. You set aside enough cash or safer investments to cover several years of living expenses. So when the market goes down, you are not forced to sell your investments at a loss. You give your portfolio time to recover because markets do recover, but only if you give them the time to do so. Now, let's talk about diversification. And I don't mean just owning a bunch of different stocks. That's not true diversification. True diversification means spreading your money across different types of assets that don't all move in the same direction at the same time. Stocks, bonds, cash, possibly even annuities, depending on your situation. Because when one part of your portfolio goes down, another part should help stabilize it. That's how you reduce risk without completely giving up growth. But here's another truth you need to hear. Diversification doesn't mean you won't lose money. It means you won't lose as much. And that difference matters. Now let's address fear, because fear is what causes the biggest financial mistakes. When the market drops, the headlines will be loud. They will be dramatic. They will make you feel like the world is ending. And that's when people panic. They sell, they move everything to cash. They try to wait until things feel safe again. And by the time things feel safe again, the market has already recovered. So they sell low and buy high. Exactly the opposite of what you should be doing. Let me be very direct with you. If you are making emotional decisions with your money, you are putting your retirement at risk. You need a plan that tells you what to do before fear shows up, not during, because in the middle of a crisis, you will not think clearly. That's human nature. So your protection strategy must be built in advance. Now, here's something very practical you can do. You need to know your number. Not how much you have, but how much you actually need. How much do you need every month to live comfortably? Once you know that number, you can build your portfolio around supporting that income, not around chasing return. Because retirement is not about having a big account balance. It's about having reliable income. That's what gives you peace of mind. And once you understand that, your entire approach changes. You start asking better questions. Instead of, how much can I make? You start asking, how do I protect what I already have? How do I make sure I don't outlive my money? And how do I make my income stable even when the market isn't? That's how you start thinking like someone who is truly prepared for retirement. Now let's talk about one more critical piece: withdrawal strategy, because how you take money out of your accounts matters just as much as how you invest it. If you're withdrawing too much during a downturn, you're accelerating the damage. So you need flexibility. Maybe you reduce your withdrawals temporarily when the market is down. Maybe you rely more on your cash reserves during those periods. The key is this: you don't follow a rigid plan that ignores what's happening in the market. You adapt, because protecting your savings is not a one-time decision. It's an ongoing process. Now, I want to leave you with something that may challenge the way you think. The goal is not to avoid every loss. That's impossible. The goal is to survive the losses. Because if your plan is strong enough to withstand a crash, then you don't have to fear it. You expect it. You prepare for it. And when it happens, you stay calm because you know you've already protected yourself. So here's your takeaway. If you are approaching retirement or already there, you need to do 3 things immediately. You need to evaluate your risk and make sure you're not overexposed. You need to build a safety buffer so you're not forced to sell during downturns. And you need a clear written plan for how you will respond when the market drops. Not if, when, because it will happen. And when it does, the people who come out okay are not the ones who guessed right. They are the ones who planned ahead. So don't wait for the next crash to figure this out, because by then it's too late to protect what you've already lost. Do it now while you still have control, because your retirement is not just about money. It's about security. It's about freedom. And most importantly, it's about peace of mind. And that is something worth protecting at all costs.